If you've spent more than a couple minutes trying to learn to day trade on YouTube, then you've seen a box on a chart and someone saying fair value gap like it's the holy grail of trading. So let's do something a little different here. And we'll go through the quick version first, the way it's normally taught, and then we'll get to the real story and really get into the origin of the concept with all of the receipts, as always, and the complete idea, not just the cherry-picked little things for clickbait and whatnot. By the way, the complete companion guide to this is free right now over at thetradingranch.com if you want to read through the complete thing with fair value gaps and everything else as well. So today I'm picking on the fair value gap. So here's the ICT on FVGs. All right. Here's the mentorship version boiled down. 3 candles. If the high of candle 1 sits below the low of candle 3, you've got a gap. Price moved so fast, it skipped a whole range. That gap supposedly acts like a magnet. Price is expected to come back and fill it. Draw a box around it, and that box becomes a place to put an order. Simple, clean, extremely popular, and also not new. So here's what it actually looks like on a chart. 3 candles, the gap between them, and the midpoint line running through it. So hang on to that midpoint line. ICT calls it consequent encroachment. We'll come back to why that matters. Every smart money account on social media talks about this like ICT found it in a booby-trapped cave on a holy quest. But bless his heart, he did not dig this concept up out of the ground. He renamed it. And the receipts go back 40 years before ICT ever picked up a microphone or a chart. So let's go back to 1985. Think of the market like a livestock auction. Say a steer is worth about $1,000. Buyers and sellers hang around that price all day, trading back and forth, and that zone is fair value. But if someone suddenly runs in yelling, "I'll pay $1,500 right now," the price shoots straight up to $1,500, and almost nobody got to bid between $1,000 and $1,500. They skipped that territory, and that skipped territory is unfinished business. And that's exactly what J. Peter Steidlmayer, a floor trader at the Chicago Board of Trade, mapped out in the early 1980s with something called auction market theory, made public in 1985. A price that barely gets visited, a single print, or a low volume node is unfinished business. The market tends to come back and revisit it later to see if it's accepted this time, since it never got to get checked before. Swap out low volume node for fair value gap, swap out volume data for candle geometry, and you're looking at the exact same idea wearing a different shirt. So strip away the branding, and this is the whole rule. Candle 1's high has to sit below candle 3's low. That's your gap, top and bottom defined. ICT calls it a draw on price. Steidlmayer in 1985 called it a low volume node, a level that the auction barely visited on the way through. Same geometry, different century, different vocabulary, same underlying bet. Thin areas in the market get revisited. Steidlmayer's own book, Markets and Market Logic from 1986, lays out fair value and auction theory in full. Mind Over Markets by Dalton Jones and Dalton is still the standard reference on market profile today. And if you want to go back even further, Edwards and Magee's technical analysis of stock trends from 1948 already had gap behavior classified into types: breakaway, runaway, and exhaustion. Also still concepts we're using today. But decades before a candles chart ever was loaded on a laptop, these guys were already working on this stuff. And here's the thing. The fair value gap isn't an isolated case. Zoom out, and almost the entire ICT vocabulary traces back the same way. Liquidity sweeps, order blocks, power of three, all of it. We're going to cover all of those across this series if y'all would like, but this map is why we don't take any single ICT claim at face value anymore, or hopefully in the first place. We go and find the root of it and study the original concept in completeness, so we can actually learn to trade like sensible humans that don't have to wear a tinfoil hat for protection from the haters. Now, the part that should actually bother you is you've probably heard that fair value gaps fill around 70% of the time. So where does that number come from? An indicator vendor's marketing blog, the same company selling you the tool that detects them, is the one that put this information out, okay? There's no disclosed sample size, there's no published methodology, no one instrument, time frame, or date range that you could go check out yourself. So compare that to what real evidence looks like, which is a published, disclosed rule set tested across multiple markets and multiple years that anyone can go audit. And it's not some big secret black box. One of those things is a study, and the other one is an ad. So here's what to actually walk away with. 1, treat the gap as context, not a guarantee. Steidlmayer never claimed that a low volume node is a sure thing either, and neither should you. 2, if at any time someone quotes you a win rate, ask for the sample size and the date range before you believe it. Trust me, it's not a mythology, even if it comes with an extra hour of brain dump and random thoughts. Number 3, backtest your own version of this rule on your own instrument before you risk real size and real accounts on someone else's unaudited number. I don't know why no one wants to spend a little bit of time to make every single day easier, but it really does happen. And then number 4, remember that midpoint line that I mentioned earlier, consequent encroachment? Don't front run the edge of the gap. Classical technicians have called the 50% level equilibrium. That's the more normal word. They've been calling it equilibrium for a century. So if you're going to react to a gap at all, that midpoint is a far more defensible spot than the raw edge. And you'll probably sound a lot more intelligent if you call it equilibrium rather than ICT made up stuff. Now let's look at how you can actually trade the original 1985 version instead of blindly buying every box some guy that paper trades drew on the internet. When price displaces aggressively, it leaves a low volume node, a thin little imbalance pocket in the price action in the market. When price pulls back into that thin little area, you don't just place a limit order or mark it in, you watch for acceptance versus rejection. So look at the first scenario where price dips into the thin gap and immediately rejects, snapping onward and back upward without building volume or spending any time. That tells you that responsive buyers are defending the auction. You buy the rejection with a tight stop right below that little tail. Now look at the other scenario. Price enters the gap, stalls for 30 minutes, and starts trading heavy volume. That's acceptance. The auction is filling in that void with two-sided trades. And if you blindly just bought that box, you're going to get run over by all that mess in there. So trade the auction, not just the shape. All right, just to kind of recap plainly, ICT did not invent this idea, but he did the work of making it teachable and shareable and turning a floor trader's intuition into some operational rules, even if they kind of leave out a lot of context and skip over a lot of important things that you should probably learn. And he did adapt it for markets that don't publish volume, like Forex, which is kind of handy. So, borrowed roots with some value added. I'm going to give credit where credit is due, but I'm not going to argue with the arguers, all right? You're allowed to hold both of those at once. And that's the ICT on the fair value gap. 40 years old, maybe even older, dressed up to look a little newer, thrown on YouTube. I'll do some more breakdowns if y'all want them, where I can dismantle kind of these myths in trading and looking into the concepts and where the original ideas actually came from, so you can learn them from the source. So head over to thetradingranch.com if you want the complete ICT guide or any of my indicators. Check out BULLBARBIE.link in the description and use code BULLBARBIE at checkout with any of the partner links and prop firms. Subscribe so you don't miss the next breakdown. Manage your risk, protect your capital, and I will see y'all in the next video. Love you. Bye.